If you have been using Bollinger Bands and consistently losing money, it is not because you don't understand the indicator. It is because you were taught the wrong approach from the beginning. Almost every Bollinger Bands tutorial teaches the same thing. Sell the upper band, buy the lower band. And here is why that is so dangerous. On certain charts, it actually works, which means you will never know it is wrong until it has already cost you real money. In this video, we are going to show you the two market conditions every Bollinger Bands trader faces, and a completely different strategy for each one, including one setup that uses the only signal Bollinger Bands produce that no other indicator in the world can replicate. These strategies work across all types of assets, stocks, forex, and crypto. This video is for every trader. With that being said, let's get started. Bollinger Bands were developed by John Bollinger in the 1980s. The indicator has three components. The middle band is a 20-period simple moving average. It shows the average price over the last 20 candles. The upper band is calculated by adding 2 standard deviations to the middle band. The lower band is calculated by subtracting 2 standard deviations from the middle band. To add this indicator in TradingView, click on Indicators and type in Bollinger Bands. Select the first result. The indicator will now be plotted on your chart. Standard deviation is a statistical measure of how much price is moving away from its average. When price swings are large, standard deviation is high. When price moves calmly, standard deviation is low. According to probability distribution theory, approximately 95% of all price action is contained within the 2 standard deviation bands. When price moves outside the bands, it is a statistically unusual event. Here is the most important concept in this entire video. The bands expand and contract based on market volatility. When the market is moving quickly and volatility is high, the bands widen. When the market is calm and volatility is low, the bands contract and become narrow. No other widely used indicator shows you volatility directly on the price chart in this way. This is what makes Bollinger Bands unique. However, and this is where 90% of traders go wrong. Just because price moves outside the bands does not mean a reversal is coming. In a strong trending market, price can walk along the upper band for many candles in a row. Selling every time the upper band is touched leads to consistent losses. We will address this fully in the strategy section. First, let us cover the 3 key uses of this indicator. The middle band is the most overlooked component of Bollinger Bands. Most traders focus only on the upper and lower bands. This is a mistake. The slope of the middle band tells you the trend. If the middle band is sloped upward and price is consistently trading above it, we can classify this as an uptrend. We should look for higher highs and higher lows to confirm the bias. If that is true, we will focus only on buying opportunities for that session. Similarly, if the middle band is sloped downward and price is consistently trading below it, we can classify this as a downtrend. We should look for lower highs and lower lows to confirm. If that is true, we will focus only on selling opportunities. There is one additional signal that most traders overlook entirely. It is called the Bollinger Band Squeeze. When the bands become extremely narrow and contracted, the market has entered a low volatility period. Here is the key insight. After every period of low volatility, a period of high volatility always follows. The market cannot stay compressed forever. When the bands begin to expand rapidly after a period of contraction, a significant move is beginning. We will build a complete strategy around this signal later in this video. The middle band acts as a dynamic level of support and resistance. Unlike a fixed horizontal level, it moves with the market. When the price is in an uptrend, the middle band acts as support. When price pulls back to the middle band, buyers step in and push the price higher. Similarly, when the price is in a downtrend, the middle band acts as resistance. When price rallies up to the middle band, sellers push the price back down. This is the use that separates profitable Bollinger Band traders from traders who consistently lose. Most traders treat Bollinger Bands as an overbought and oversold indicator. They sell when price hits the upper band and buy when price hits the lower band. This approach works, but only in one specific market condition. It works when the market is ranging sideways. In a trending market, it does not work. When the market is trending upward, touching the upper band is a sign of strength. It is not a reason to sell. Always identify the market condition first before deciding how to use the bands. This is the fix that 90% of traders are missing. Before the strategies, let us set up the indicator correctly for day trading. The default settings, a 20-period SMA with 2 standard deviations, are the settings used by institutional traders and market professionals. We will keep these unchanged. What we will adjust is the visual appearance. In the Style tab, change the middle band to blue and both outer bands to orange. This makes each component immediately clear on the chart. For the time frame, we will use the 5-minute chart. In my experience, the 5-minute time frame is ideal for day trading. Lower time frames introduce too much market noise. Higher timeframes can cause you to miss important intraday price action. All chart examples from this point forward are on the 5-minute chart. The trades shown use high-volume assets, the S&P 500, Tesla, Apple, and Microsoft. When using these strategies, choose assets with strong liquidity and good daily volume. Illiquid assets produce unreliable signals. Let's start with strategy 1, middle band pullbacks. The core idea here is simple. You're entering an existing trend during a temporary pullback to the middle band. A pullback is just a brief pause or slight reversal against the trend direction. In a healthy trend, these pullbacks create the ideal entry point. The first step is confirming the trend actually exists. There are 2 valid scenarios for a bullish setup. In the first, price has been above the middle band since early in the session. In the second, price briefly dipped below the middle band after the open, but recovered within the first 5 or 6 candles and has stayed above it since. Once the trend is confirmed, you wait for the pullback to the middle band. When price returns to the middle band in an uptrend, buyers see this as a fair value entry. But don't enter blindly. You need confluence before entering. Confluence means the middle band coincides with a support or resistance level from the previous trading session. When you've got 2 separate reasons for price to hold at that exact level, it significantly increases the probability of the trade working. The final step is waiting for a confirmation candle. For a buy setup, you're looking for a bullish hammer, a strong green candle closing near its highs, or a bullish engulfing candle. For a sell setup, it's the mirror image, a bearish hammer, a strong red candle closing near its lows, or a bearish engulfing candle. Never enter until that confirmation candle has fully closed. So here's what a clean long setup looks like. Price establishes a clear uptrend. The middle band is sloping upward, and price is trading above it consistently. Price pulls back to the middle band. That middle band coincides with a support level from the previous session, so we've got confluence. Then a bullish hammer forms at this level, confirming that buyers are defending the price. Your entry is the close of that confirmation candle. Your stop loss goes below the recent swing low. Your primary exit is a 2-to-1 risk-reward target. And your secondary exit, this is important. If price closes back below the middle band before you hit that target, exit immediately. That's your signal the trend is losing strength. The short setup works the same way in reverse. Price opens and quickly drops below the middle band, confirming the downtrend. The middle band is sloping downward. Price rallies back up to the middle band, and that level coincides with resistance from the previous session. Confluence again. Then a strong red candle closes near its lows below the middle band, giving you bearish confirmation. Entry is the close of that bearish confirmation candle. Stop loss goes above the recent swing high. Primary exit is your 2-to-1 target, and your secondary exit is the same rule. If price closes back above the middle band before the target is reached, get out immediately. But what happens when the market is not trending? Most traders have no answer to that question. Strategy 2 is built exactly for this situation, and it uses the one signal that Bollinger Bands produce that no other indicator can replicate. The core idea is this. When the bands squeeze into a narrow range, the market is in a low volatility period. A significant move always follows. We position ourselves for the breakout before it even happens. This strategy is designed specifically for sideways, non-trending markets, the exact conditions where strategy 1 doesn't apply. You're looking for bands that have contracted significantly compared to their recent range, with the middle band relatively flat and price moving sideways without a clear directional bias. To make the squeeze easier to identify, add a second indicator, Bollinger Bands Width, or BBW. It plots a single line showing how far apart the bands are at any given moment. A low value means the bands are narrow and a squeeze is occurring. A high value means the bands are wide and volatility is expanding. Here's the key, don't enter during the squeeze itself. You're watching and waiting, not trading. The signal to act is the BBW line beginning to rise from its low point. When the bands start to visibly expand on the chart, and the BBW is rising, a breakout is beginning. From there, use price action to identify which direction the breakout is heading. Multiple candles forming on the downside with one closing outside the lower band signals a bearish breakout. Multiple candles forming on the upside with one closing outside the upper band signals a bullish breakout. Don't enter on the breakout candle alone. Wait for additional confirmation using the Money Flow Index, or MFI. In the MFI settings, set both values to 50, giving you a single midline to work with. When MFI crosses above the midline, that's your bullish signal. When it crosses below, that's bearish. Here's what a clean long setup looks like. The market's been moving sideways. Flat middle band, contracted bands, low BBW reading. Then the BBW begins to rise as expansion starts. A strong green candle closes outside the upper band, confirming bullish price action. MFI crosses above the 50 midline, giving you bullish confirmation. All your signals are aligned, so you enter a buy trade at the close of that MFI confirmation candle. Your entry is the close of the MFI confirmation candle. Stop loss goes below the lowest point of the squeeze zone. Primary exit is your 2-to-1 risk-reward target. And your secondary exit, if price closes back below the middle band before the target is reached, the breakout has failed. Exit immediately and protect your capital. The short setup mirrors this exactly. Sideways market, flat middle band, contracted bands, low BBBW reading. BBW begins to rise as expansion starts. Multiple red candles form, with one closing below the lower band, confirming bearish price action. MFI crosses below the 50 midline for bearish confirmation. You enter your sell at the close of that MFI confirmation candle. Stop loss goes above the highest point of the squeeze zone. Primary exit is your 2-to-1 target, and the same secondary exit rule applies. If price closes back above the middle band, exit immediately, because the breakout has failed. That brings us to the end of this video. To summarize, Bollinger Bands are a volatility indicator, not an overbought and oversold indicator. The biggest mistake traders make is treating every band touch as an automatic buy or sell signal. The correct approach is to identify the market condition first. If the market is trending, use strategy 1. Enter pullbacks to the middle band with confluence and a confirmation candle. Exit at your 2-to-1 target, or immediately when price closes back through the middle band. If the market is sideways and the bands are squeezing, use strategy 2. Wait for the squeeze, wait for the expansion, and confirm the direction using price action and the money flow index. Exit at your 2-to-1 target, or immediately when price closes back through the middle band. Always add confirmation before entering any trade. A Bollinger Band level alone is a reason to pay attention, not a reason to enter. If you find value in this video, be sure to hit that like button and subscribe to our channel so you never miss any of our new videos. See you soon.